Today we have a very special guest, Rob Kaplan, Vice Chairman of Goldman Sachs. You were an investment banker. You went to Harvard Business School to teach. You got appointed to be head of the Dallas Fed. A few years later, you made your way back to Vice Chairman of Goldman Sachs. You, sir, are in the room where it happens. The President of the United States is putting a lot of pressure on the Fed, more than usual. What are your thoughts on what's going on right now?
I'll talk about what the pressure is and then what they're likely to do.
Turn to tariffs for a second.
Certain industries that rely heavily on imported goods, they're not going out of business, but they've got margin erosion.
What makes a good investment banker?
You give straight up advice. It may be saying to them strategically they're making a mistake, and that's what clients value the most.
You were president of the Dallas Fed. Was there ever a time that you think you knew something about the U.S. economy or the regional economy that the rest of the world did not?
Yes.
Give me an example. Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. And today we have a very special guest, Rob Kaplan, Vice Chairman of Goldman Sachs. Welcome, Rob.
Good to see you, Steve.
So before we start, and we do know each other socially,
we do
so
know
full
each
disclosure.
Other. Absolutely.
Let me read a little bit about your bio, because you're on CNBC a lot, but I don't think everybody necessarily knows your history. So let me I printed it out off Wikipedia. You have a nice Wikipedia page. So you started your career basically at Goldman.
Yeah.
You were an investment banker.
Yeah, I was.
Then eventually you became head of the investment banking department. No small feat. And then you became vice chairman of Goldman. And then in 2006, you left. You went to Harvard Business School to teach.
Yep.
And then in 2015, you got appointed, I guess by President Obama, to be head of the Dallas Fed.
Yeah. And the way a Fed president works, you get picked by the local board, approved by the board of governors. So it's not a presidential appointee.
It's not a presidential appointment.
It's not. But it has to be approved by the board of governors.
I see. And then you left in 2021, and a few years later, you made your way back to the same position you left, Vice Chairman of Goldman Sachs.
I did.
So the way I like to think about this is the difference between your career and my career is I was a sell-side analyst and a hedge fund manager. That makes me a professional critic. You, sir, are in the room where it happens.
Maybe.
As in Hamilton, as they said in the play.
Right.
So let's start with today's headlines and see. I mean, it's very controversial right now, and I'd be very curious as to I have my own thoughts, but the President of the United States is putting a lot of pressure on the Fed, more than usual. What are your thoughts on what's going on right now?
So I'll talk about what the pressure is and then what they're likely to do.
Okay.
Right now, GDP growth in the United States is 1.25%, 1.5%. We know that the job market is weak. Unemployment has stayed low, but only because there's a lack of labor supply. In fact, labor supply is declining.
Has collapsed.
Yeah. And so we need higher growth. And we've got a couple things that are headwinds to growth. One is the tariffs are headwinds to growth. They may ultimately lead to more growth, but not in the short run.
You can't build a factory overnight.
That's right. And then the other thing is because we are we've reduced undocumented immigration, fair enough. We haven't ramped up legal immigration, but we've got 10 to 15 million workers in this country that are undocumented, and we haven't clarified their status. And in fact, we're making them feel like some of them are going to leave, and some percentage aren't showing up at work. That's a headwind for growth. Regulatory review should help. I think review of the energy ecosystem, the AI data center power boom should help. And so you could see why a president of the United States would want lower rates, because it would help growth. But however, at the Fed, that's not their mandate is much more specific. It's not to get GDP growth higher in the next year. Their mandate is full employment and price stability. And the problem they're dealing with is while employment is weaker, inflation is well above target.
Where is inflation now? 3?
Inflation depends. Probably 2.75 to 3, depends on what you look at. And I don't think that's the end of the world if it were heading in the right direction. But I think service sector inflation had made progress, but it's kind of sticky right now. I think the tight labor force probably makes it stickier. Rents are in there too. And we know that there'll be some impact on goods from tariffs. I'm more optimistic there'll be one-time impacts. We know it doesn't help inflation. And so if you're the Fed, you want to get inflation lower, and I'll explain why as we talk. You got to deal with the labor market weakness, but you're not going to cut rates maybe as much as people on the outside might like, because your job is to try to control inflation. I think this labor market weakness will get them to cut in September.
But you think only 25?
They'll cut, I think, more likely 25. And I think the other thing people don't realize, the neutral rate of interest right now, in other words, where would we be at equilibrium? Inflation's at 2 3/4. I think the real neutral rate is probably 0.75%. If I'm wrong, maybe it's a little higher, but say 3/4. That's 3.5.
And where's Fed funds now?
4.25, 4.5. Now, a year ago, it was 5.25, 5.5. In my opinion, a lot of room to cut.
Right.
Right now, not so much room to cut. Maybe 75 to 100 basis points
Total.
if you want to get to neutral.
Right.
And I think the Fed will be reluctant to get to neutral with inflation running above target. So that's why you've got this tension. You've got
more than just that tension.
Yes, but there's
and let me press it, because I mean, you'll say what you're comfortable saying, obviously, but it's been a long time, I think, since a president of the United States has basically taken on the Fed anywhere close to what's happening right now. I mean, you've got the Lisa Cook situation. Mm-hmm. So, I mean, I'm not going to ask you to comment about, what you think about the president's doing. But like I said before, you were in the room where it happens. What do you think is happening at the Fed meetings? I mean, this must be discussed.
I can tell you what I think is happening at the Fed meeting. It is not being discussed.
It's not being discussed.
Absolutely not. And remember, I was at the Fed during the first Trump administration. He also wanted rates lower.
He certainly did.
Although it's more intense now.
Yes.
What you do when you're at the Fed, and what I would be getting my team to do if I were there right now, focused on the job. The job is to make sure we create full employment and price stability. Let's understand the economy. Let's talk to businesses. Let's make sure we understand the structural drivers, understand the data. Got a supervision job to do, and you also have other aspects of the job. But I would focus my team and say, I don't want you to take into account at all political pressure or political consideration.
You think Powell is telling that to his team?
You bet. And I would be too, and I'm sure he is. And saying, let's make the best decision we can and let the chips fall where they may. We're going to get criticized, whatever we do. Let's make the best decision. And I think that's exactly what he's doing.
And you think everybody in the Fed is like that?
I think that I believe there is an enormously strong ethic inside the Fed to be like that. Okay, now there's 19 people around the table.
How many vote?
12 out of the 19.
12 out of the 19.
And the reason it's 12, the presidents rotate their vote. Now, some people would say—
The presidents of the regional Fed.
The president's regional Fed, sorry. And so I think some people may say, maybe this person or that person is shading their views because they want to be Fed chair. I'm not even sure that's happening, but there's a couple of people that are being more dovish, and some people would say, I don't know that I believe that. But yes, around the table, I believe very strongly people are making the best decision they can, understanding that they're going to get criticized, that there's political pressure. They're doing everything they can to ignore it. And if I were there, I'd be encouraging my colleagues to do that. I'd be encouraging my team to keep focused, and I would be striving for that myself.
So nobody in the room, you think, would say something like, I'm on the fence, so I think we should probably cut because this way the president will get off our back, or shade it in a way that's more diplomatic?
I'd say the odds of that happening are either zero or as close to zero as you can get. I would be horrified, and I think the people around the table would find that completely unacceptable if somebody even intimated at that.
Totally inappropriate.
Correct.
Okay. But you think they're going to cut 25? There are people who are saying 50 these days, but I'm with you.
I think they're going to cut 25 because I do believe the labor market is weak. I want to make sure it doesn't get weaker. The reason I would do, though, 25, not 50, it's not that weak. It's sluggish. Mm-hmm. And also, I'm very aware of the fact any 1 or 2 months of labor data may be wrong. They may get revised. And I'm talking to businesses regularly, and I'm in a firm where we're talking to businesses. I don't hear businesses telling me that business is falling off a cliff or that hiring's. I hear it's sluggish and weakness and caution. I don't hear falling off a cliff. That would be another reason I'd be more inclined.
What I've heard,
I'd be more inclined to be at 25 than 50.
I mean, what I've heard from people is that basically the economy is okay, but because of the tariffs, people have kind of pulled back. And that's kind of what's creating the sluggishness.
So here's where there's real weakness.
Okay.
Certain industries that rely heavily on imported goods, they're not going out of business, but they've got margin erosion.
Like which?
Anybody who imports goods from Vietnam and uses, and I don't want to mention names of companies, I'll avoid it, but I have names in mind and you can think of the names.
So somebody imports parts from Vietnam, something like that.
Correct. Or textiles or sneakers or T-shirts.
Right.
You will see that they're getting some margin erosion. In addition, costs have gone up in certain industries. In addition, the farmers, for example, their markets overseas are more challenged and their costs are somewhat higher. In addition to that, those are just the big business, before the farmers, the big businesses. Small businesses I talk to are telling me the following. I'm going to see how this goes, but by the end of the year, I may in fact close my business because I can't position these goods. I can't take these risks. And so I'm seeing meaningful weakness among small businesses who before this had used importing. So it's not that there's not weakness. There's real weakness out there.
Interesting.
Now, what's offsetting it is you've got an AI data center power boom in the United States, which is going to drive more growth and investment. And the other sector I'll throw out because I'd be remiss in not as a housing sector. Housing sector has got indigestion and is very sluggish. It's harder to build a new home, costs are up, and affordability is more difficult because of rates higher. So you've got a lot of sluggishness out there.
So let me turn to tariffs for a second. You know, the president is trying to bring jobs back, factories back. He's created a tax bill, which in some ways is extraordinary. I mean, you build a factory in the United States, you get to write off 100%.
That's right.
So in your discussions with businesses, are people interested in creating more factories in the United States, or they're kind of not so fast?
They are subject to a couple of things.
Okay.
First of all, people in business want to consider domiciling here if it's high value added manufacturing, not low value added.
So not T-shirts.
Correct. And secondly, the first question they ask when they do it, is it going to be globally competitive? Can I figure out how to, and this is why the relationship with Mexico and Canada is so essential to that decision. Many businesses were able to get over the hump to domicile here because I bought cheap natural resources from Canada and used cheap labor from Mexico. And that, as part of the equation, let me domicile here and believe I was going to be globally competitive. And if people are struggling right now, it's what I don't want to do as a CEO is build an operation that is only competitive because of a tariff moat. Because my worry is in the next 5 or 10 years,
it goes away.
Maybe we'll go away.
Right.
And that's the issue. Now, how many businesses will fit through that funnel? I still think a number of them will. And I hear that. But that's the caution when there's a caution.
Let's go back to the Fed for a second. So when you started at the Fed, Yellen was chair.
That's right.
And when you left, Powell was chair.
Right.
Any difference?
Very. I mean, they're different people. The nature of the job was the same in that if you're Fed chair, you need to articulate views on the economy on your own 2 feet, and you need to be respected for having views on your own 2 feet. Both do. They have different backgrounds. You need to then build a consensus around the table because the Fed chair, despite what the press may say, doesn't decide on his or her own. You have 12 voters and you need a majority of those votes. So he or she's got to be good at that. And you have to be a reasonably good communicator to explain what the Fed is doing to the external world. I think Janet Yellen was an incredibly accomplished labor economist, and she had deep grounding in economics. You talk to leading economists around the country, they more often they'll say, Janet Yellen was my advisor when I was getting my PhD.
Seriously?
You bet. She had a profound impact, and she was a very accomplished economist. She would be the first to say she wasn't as thrilled with doing regular press conferences, but she was formidable. And I found her to be so, and you learn an enormous amount every time she speaks. Jay has a business background.
Less of an economist background.
He's not an economist background. Now, what Jay did, and he and I talked about this a lot, he had to do a deep dive in the same way I did. I'm not an economist either, and learn all the economics. Jay is got good common sense. He's got the right temperament for this. He's good at building, in my opinion, consensus. There were times I disagreed with him, but I think he did a very fine job, and he's a very good communicator, in my opinion.
He's an excellent communicator.
Yeah.
His press conferences are very good.
He's a very good communicator.
At saying nothing.
Well, people have to remember Jay has a legal background.
Yeah.
And sometimes you will see that legal background. He's very careful what he says. So a lot of people, when he'll speak, or he'll give the speech at Jackson Hole 2 weeks ago, and people will ask, well, didn't he really mean this? And I said, no. He says exactly what he means. He's one guy. Take him literally.
Yeah. I had a joke on my podcast that Friday at Jackson Hole. I said, I got a question. Why did the market rally? And I said, because Jay Powell said nothing, but he said it really well. And that's kind of what happened.
And well, what he did is he opened the door to a rate cut in September, and he suggested that they're going to have a little bit more awareness and balance between labor and inflation. I think the market took that and maybe overinterpreted what he said, but that's what he said.
Right. I got a question for you. You were president of the Dallas Fed. I would say there's not one person in a million who could string together a sentence that could say what that means. What does it mean to be head of the Dallas Fed? What is that job?
So let's talk about what a Fed president does and what you do. And because when I took the job, I had to learn what it meant. We have 1,300 people at the Dallas Fed.
1,300.
1,300.
Wow.
So what do? We have several hundred in supervision. We've got a big research department. We have a big community outreach. In addition, there are 12 reserve banks in the United States. As a group, the 12 reserve banks do orchestrate payments in the United States. If you send a wire, Fed wire, ACH, we do a number of functions that we work together as a team. During my career at the Fed, I was asked to chair the committee overseeing all budgeting at the Fed. I chaired the committee looking at all technology at the Fed. We have an enormous technology effort spread throughout the system. So as a Fed president, I'm running my bank. I'm running processes through the system, but the most important thing I'm doing is working with my team of about 30 economists to do outreach to businesses through the state of Texas.
What do you mean by outreach?
Outreach means I'm talking to businesses every day and basically trying to understand what's going
happening
on with their business, and particularly as it relates to the employment and inflation. I'm traveling to Mexico regularly. I've traveled probably more than any president to Mexico to try to understand what's going on in Mexico, and that the trade relationship between Mexico, Canada, and the United States. I went to Canada regularly because Texas is a very large exporter and a very large importer. I spent a lot of time in my job on the oil and gas industry. We're the largest, obviously, oil-producing state in the United States. So I had to be the expert around the FOMC table on energy and oil and gas. But the other big part of the job, which I took seriously, is working with my peers around the system to try to add insights, listen to their insights. And so there's the running the bank, but there's trying to understand, trying to come up with views on the local economy, the national economy, and the global economy, and comparing notes with my peers and using my team to try to form a view on what's the state of the economy and what should we be doing on monetary policy.
So was there ever a time that from that process that you think you knew something about the U.S. economy or the regional economy that the rest of the world did not?
Yes.
Give me an example.
Well, I had a couple of I was an outlier.
Give me some outlying
times. Okay, so let's give you an example of an outlier. The most notable outlier was in September of 2020. the Fed, the team at the Board of Governors proposed that we commit to leaving rates at zero until we reach full employment.
This is obviously during COVID.
We're 6 months into COVID. And I felt very strongly, usually if the whole group disagrees with you, the first thought is, maybe I'm wrong.
Right.
This is one where I felt like, no, we're right and they're wrong. I felt it was a mistake to use forward guidance that aggressively, to commit now that we're going to keep rates at zero until we reach full employment. Why is that? First of all, there was no inflation out. If you can believe this, there was no inflation out. So it just didn't make, and why does it make, as you approach full employment coming out of COVID, my view and the view of my team was the neutral rate would drift up. Mm. If you commit to keeping rates at zero, that would be the same as you approaching an intersection where there's a green light turning to red, and instead of taking your foot off the accelerator, you floor it, because the degree of accommodation gets bigger and bigger and bigger. And I thought it was so obvious that I tried to talk Jay out of it, Jay Powell. I tried to talk my peers out of it, but I think they felt strongly we had just passed this new framework. You may remember from 5 years ago, and they wanted to show we were serious about average inflation targeting. And so I dissented. I wrote a public essay. I did a bunch of interviews explaining why it was a mistake. Now, what I had to learn to do then, once you've dissented and you make clear to the whole world, I disagree, you can keep carrying that around, or you have to say the group has decided, okay, and let's play on from there. But I felt strongly we should not keep bond buying at the same level, and we certainly should not commit to keeping rates at zero. And that was something I thought was clear and obvious to me.
Why was it clear to you? Was there economic data as you were getting that things were actually better than
I
you thought?
By that time, been at the Fed for close to 5 years. I had enough experience. And I think I already was of the view that forward guidance in the past maybe at times had been overused. I was 5 years into it, and I had a great team. And I was far enough in that I had a lot of confidence, at least on that issue, that this was some say. I didn't know what we should do with rates over the next year, but I knew we shouldn't commit to keeping them at zero. Okay, now the second thing that I was an outlier on, I felt the fiscal policy, $2 trillion CARES Act, $2 trillion American Rescue Act, $1 trillion later of the Inflation Reduction Act and Infrastructure Act. I felt that the excess fiscal, that's extraordinary amount of fiscal, that monetary policy, we should be taking that into account. And what you don't want to do is have extraordinarily accommodative fiscal and extraordinarily accommodative monetary. You shouldn't do both.
And that's what we got the inflation from.
I believe it. It started as a supply chain issue. It morphed into an excess demand issue. The only other thing that I was an outlier on, but the people at the Fed, I think, tried to understand where I was coming from. I was a big believer in the role of technology-enabled disruption, in that I did feel pre-COVID that technology was eating up jobs and was disinflationary. And it meant that maybe we could be more aggressive at that time, pre-COVID, on keeping the Fed funds rate lower, getting the unemployment rate lower without triggering inflation.
Mm. All right, let's switch gears. Let's go back in time. It's the 90s.
Yeah.
You're not yet head of the investment banking department,
right,
but you're a pretty senior investment banker.
Yeah.
I got a very simple question. What makes a good investment banker?
So the most important thing an investment banker does, you know your client, you know their industry, you know the markets.
What was your area?
I didn't have an area.
You were a generalist.
I started off early on. I ran the junk bond business early in my career, but by the time I got to the 90s, I was probably running the corporate finance department. And so I was a generalist. I worked in every industry. I knew enough to be dangerous about, you work enough on certain industries, but nobody expected me to be a specialist. I did raid defense I was a junk bond expert, and I worked across a range of industries. So the most important thing you do is learn the industry, understand the business, understand the markets, and then the most important thing you do, put yourself in what makes a great banker, though, on the margin, I put yourself in the shoes of the CEO and the company and decide what you would do if you were them and give them that advice.
So explain that better. I'm not sure why that's the thing to do.
My job is to try to figure out, if I were sitting in the CEO's seat, what I would do if I were him or her.
Mm-hmm. And then try and convince them to do it?
Well, give them that advice. Bring to bear everything I know about the markets, everything I know about their company and their business. And so that means sometimes client wants to do a deal, you talk them out of it. It may mean sometimes you push them to think about things they weren't thinking about. So it can go both ways. But what makes a good banker? You give straight up advice. That may sometimes be talking a client again out of doing something. It may be saying to them strategically they're making a mistake and they need to relook. And that's what clients value the most, in my experience.
So can you say what was like your best deal?
Well, probably the most one I remember the most, there were two, and they were both raid defenses. One was the raid defense.
What does that mean, raid defense?
So the client got raided.
Oh, raided. Okay.
The client got raided. So what's one?
That's a long time ago, raids.
Well, we don't see them like that. That's the world has changed.
Yes.
But back in 97, Santa Fe Railroad got raided by Union Pacific, if you can remember that. And it was a 8 or 9 month defense, and we wound up merging Santa Fe with Burlington. And the reason I remember it was these raids in those days were all out wars. The other big one was defending ITT from Hilton. That went on for close to a year. And we wound up splitting up the company. We wound up merging. That's how we merged with Barry Sternlicht and Starwood by the end of it. And the reason I remember it, though, it was a saga that went on chapter after chapter after chapter. It turned out to be the outcomes were, I think, the very best thing for both companies. But it was stressful, and you don't see raid defenses like that today. But those are things that I remember in my mind.
So I was thinking about the Kraft Heinz deal.
Yeah.
That's coming undone, right? Or may be coming undone. And my question to you is, I mean, you've done a lot of deals.
Yeah.
Some deals I'm sure worked out great, and some deals I'm sure did not work out great. That's kind of the M&A game. A lot work, a lot don't. What is there a lesson to be taken from the deals that worked out great? And is there a lesson to be taken from the deals that did not?
So what I always used to say and I still say today doing mergers, is doing the deal is maybe half of the first inning. The integration, running the two companies together, is 9/10 of the battle. And I won't get into individual companies, but you've seen situations where the managements either didn't meld together well, or a strategy that worked for the acquirer, in one case, cost cutting and other things, maybe even that had gone a little bit too far, and the strategy really wasn't consistent with building a distinctive brand, just building a distinctive business. And so I always tried when I worked on merger deals to really, really think through. Was there a strong CEO? Was there enough on both sides, and the teams and the proposed structure where all the cost cutting, value enhancement, brand, and market penetration, did it make sense to me that you could do all those things? But that is really hard. And most investment bankers actually have never done that.
Never done what?
They've never actually done an integration between two companies.
Of course.
They do deals, and the managements do it. And I've learned some managements are very good at doing integration, and some are not as good. The better run the company, the more likely they're going to do a good job integrating. And it can be uneven. And you have to think about that. There are some companies who want to be acquisitive. It makes sense strategically, and they don't have the acquisition gene. They're used to building everything organically. They haven't built the acquisition gene, and you got to caution them. You guys got to build. There's certain attributes that go with being a successful acquirer.
Like what?
you've got to be, and a lot of these are very hard-nosed things to do. You've got to assess where the overlap is. You've got to make the brutal steps of recognizing cuts. You have to be good at meeting a whole range of new people you're going to work with and integrating them. You need a very strong HR function that is good at integrating them and making the new people feel like they're part of the whole company. Some companies are very well run, but they've never had to in size. They're used to bringing on ones and twos and 10s and 20s and 30s, but bringing on thousands is a different task, and it's harder, and you've got to be ready for it.
Let's talk about Goldman Sachs. So you left in 2006. You went back 2021. It's a different world.
Yes.
So I don't think most people understand how different the world. So, I mean, I know it from math and how the companies function.
Yeah.
But what I'm very curious is you left basically pre-crisis.
Yes.
And then you showed up years after, even after Tarullo left.
Many years later.
So how different? Describe Goldman Sachs. What's that world like, and what's the world like today?
So let me comment on, there were two things that were very different. First, Goldman Sachs was very different, and I was very different. If I had not been very different, it also would not have made sense to go back. Here's how Goldman Sachs was different, and I'll talk about how I was different that fit that. The firm is dramatically, we were global when I left, but the global footprint has been built out much more. I was just in Asia last week. I first went to Hong Kong 35 years ago. We had 3 employees and a fish tank, and the feng shui doctor had been in. But that was about it. And we went on a multi-decade build, and now we have a very strong business all through Asia Pacific. We've built out Australia, that's dramatically new. I mean, we are just we're not where we want to go yet, but we're much stronger. We're built out much stronger in Europe. We're globally stronger. And the other thing, when I left the asset management business, wealth management business, we were several years into it, but we've dramatically increased. We've still got also a long way to meet our ambitions, but we're dramatically more penetrated and a much more big, sizable, interesting asset management business. The other thing is, when I left, banking might have been, I'm making this up, 35% of the revenues, maybe 40%, and we traded a lot and we had some asset management. And in some years, you may remember, the trading was an enormous amount of our business, and it created a lot of conflicts with our clients. Okay, here's what's changed.
What do you mean by conflicts with your clients?
Sometimes when you are either investing or you're trading, you will accumulate a position that might create a conflict with one of your clients. The firm has done a dramatic change in that when we commit capital today, we don't commit it. We tend not to commit it for our own account. We commit it on behalf of a client. We use our balance sheet now.
So there's very little prop trading compared to there used to be.
That's right. We now think clients. I live by at the firm, business principle number 1, clients' interests come first, our own interests will follow. I think we're ironically truer to that today than when I left in 2006, because we don't have that. We've eliminated the client conflicts, and that if we commit capital, it's always going to be on behalf of a client. And I think that's smarter. By the way, it's a higher PE business to commit it on behalf of clients. And the other thing that is dramatically different is when I left, we were collaborative between the divisions, but we didn't work together that well. And this predates me. I think John Waldron and David Solomon have initiated something called 1GS, and I see it for real. The divisions now work together aggressively to serve clients around the world. And I work on a whole range of 1GS client, but every client we have, if you're doing business with one part of the firm, we bring the whole firm to bear. That's a dramatic improvement. What's more challenging than when I left, I forget, maybe when I left, we had 12 or 15,000 people. Today, we have 50,000 people, more sprawled around the world. And so what I've noticed, and one of the things I do being back, I spend 3/4 of my time on clients, but I spend an enormous amount of time mentoring and coaching leaders on how to create more engagement. It's harder to create engagement when you're 50,000 than when you're 12,000.
When you say you engage with clients, like what do you do?
I call on them. I work on clients in every division. I'm firm-wide. So here's what's changed about me. When I left, I oversaw investment banking and investment management, but the truth is I was primarily an investment banker and I was learning investment management. I left, I taught for 10 years at Harvard Business School. I learned how to teach leadership development. I became more strategic and I worked with hundreds and hundreds of companies away from financial services. I learned a lot. I wrote 3 books on leadership. I learned a lot. And then the other thing is I learned a lot more than I ever understood about the U.S. economy and global economy from being at the Fed. It turned out both those skills were enormously valuable to today's Goldman Sachs in that I spent a lot more time in my job on macro, working with investing clients, trading clients, hedge funds. Not just, I still work on investment banking clients, but I work on clients firm-wide. But the macro background, I just didn't have that to add where I can add value to a broader range of clients. And the leadership development, I do more of that inside the firm and with clients than I ever did during my first stint at the firm. So the firm's more interesting and broader, and I've gotten, I hope, a little more interesting and broader. But I was going to go run another financial services firm or doing something more entrepreneurial. But when David and John started to talk to me, it occurred to me that what the firm needed and what I could do were uniquely well suited. And I still, in my heart, it's basically the only place I've ever worked.
Goldman.
It's basically the only place I ever worked, in a for-profit job other than Pete Marwick, as an accountant. So
let me tell you a story. You see if you want to comment.
Mm-hmm.
So Gretchen Morgenson, who's a personal friend, and who I actually interviewed on the podcast several months ago, wrote an article about Goldman way after the crisis. It was a pretty controversial article.
Mm-hmm.
And she said that Goldman had something like the 14 principles of Goldman Sachs. I think it was.
Business principles.
Business principles, which were all basically variations of the client comes first.
Mm-hmm.
And she said, and this was her argument, that Lloyd Blankfein had created a 15th principle, which superseded the other 14, which was everybody's a counterparty. That's what she said. Now, I know that article did not go over well at Goldman Sachs.
Right. No, I can imagine it wouldn't.
But that was her argument. Years later, I'm at a meeting at the firm that I'm working at, and David Solomon comes to our firm, and the entire firm showed up. It was a great meeting. And during the meeting, he said something, and I'm much more sensitive to this than other people are, obviously because of my history. He said, I don't have the exact words, but it's more or less, he said that one of the things he's trying to do is to make Goldman Sachs, I don't know if he said back to its roots, but he basically implied, I am making the firm much more client-centric than it was when I showed up.
Yep.
That's basically what he said.
Yep.
And after the meeting, I went up to him, very quiet. I never asked a question during the meeting. I didn't think it was appropriate. And I went up to him and I said, I mentioned Gretchen's article. And I said, and I'm going to quote back to you what you just said. So I quoted back to him. And I said to him, correct me if I'm wrong, but it sounds to me like you agreed with Gretchen. And he basically nodded his head. He didn't say anything, but he didn't say no. And I'm wondering if that's one of the reasons why you came back.
Here's several reasons why I came back. The reasons I said I thought I could add enormous value, but to me, the guiding light in my career was always actually 2 business principles. First, clients' interests come first, and if they succeed, our own interests will follow. And I felt strongly, and David and John convinced me, and they were right. And I talked to the division heads also, management committee members, before I agreed to join, that commitment to that principle is as strong as it's ever been. And now that I've been back for a year and a half, I would say that commitment is as strong as any time in the 40 years plus I've been involved with the firm. So otherwise, I wouldn't have come back. Second thing, people are our most important assets, and we need to act accordingly. And I felt I could help enormous amount on that. And so I won't get into the blow by blow and who did what,
I'm not asking,
but I will say this.
I wanted to bring it up.
The guiding light of what makes Goldman Sachs, to me, what makes Goldman Sachs special, what makes Goldman Sachs is clients' interests come first. It was written by John Whitehead way back when. Clients' interests come first. If they succeed, our own interests will follow. And I think we are. And you got to give David Solomon and John Waldron and the leadership of the firm and all the people involved. I can't take credit for it. We have made enormous improvements in being true to that principle. You're never perfect, but I feel very good about trying to fulfill that aspiration.
So last question about Goldman. So, when Gorman took over Morgan Stanley, he really transformed the company.
Yeah.
I mean, dramatically. He made it more steady Eddie, less capital intensive. Goldman tried to do
big wealth management. Enormous.
He brought E-Trade. He made a lot of M&A moves that, in retrospect, are extremely impressive.
Yeah, did well.
Goldman tried to build some things internally that didn't work out, and you've gotten rid of them.
Mm-hmm.
So fast forward a couple of years, what's the direction of the firm in terms of diversification? Like, what are you guys trying to accomplish?
Well, we have two big divisions, as you know, global markets as well as asset and wealth management. We have been very focused on building them primarily organically. I will defer to David Solomon, as I should, and John Walden to talk about strategically any things we might do to help bolster that. But
you did a little something with T. Rowe Price the other day.
Correct. And which I think was going to be a fantastic thing for us. And you may see us do other things. But it's all in service of building those two big businesses, but with a view, is it better able to help us serve clients' interests? And so I think I'm not going to talk about it because it's not appropriate for me to, but I think you'll see us continue to build our franchise and build our firm. So I'm not answering you on strategic stuff, but I don't think it's appropriate for me to.
That's fine. How much harder is it to run? Forget about the size.
Yeah.
It's an entirely different regulatory environment today than when you left. I mean, the capital requirements are higher. You've got the stress test. Like, just give us a little flavor, like how much harder it is to run a firm given those restrictions.
I'm going to give you an industry view and as a former Fed president view. Mm-hmm. I think the stress test post-financial crisis were excellent, were a great innovation. In fact, I worry today about the non-bank financial system that doesn't have stress testing. It's not part of it. But I think stress testing, should make people feel not perfect, but much better that we're stressing the balance sheet in extreme scenarios to make sure we don't have an issue like we had during the financial crisis. And I think that's a great development. And I think in the industry, we should be pleased about that. Here's the issue. Beyond that, and particularly in the aftermath of Silicon Valley Bank and First Republic, I think there were a whole range of additional initiatives where I'm a big fan. I taught leadership for a living, you may remember, and I think you want to focus and prioritize what you're trying to do. And I think a little bit when I was I just left the Fed, but I was very disappointed at the Fed with all this range of regulation. There was a lack of prioritization where you could allow in the 15th and 16th largest banks in the United States a glaring, and not hidden.
It's an embarrassment.
A glaring asset liability mismatch. And it showed me that the supervisors and the regulators are focused on too many things. Some are vital, some are foot faults, and there's not enough differentiation between something that's vital and something that's a foot fault. And I think to the extent that Mickey Bowman and others are going to have a re-review, with a cost-benefit analysis of regulation, I think that's a good thing because you want regulators and supervisors to be focused on the most significant risks. And I think there's probably work to be done. And for small banks, and I live in a state with Texas with 600 small banks, there needs to be some tailoring done where you want these small banks to not be so buried by regulation they can't really make it independently anymore, and you want them to serve their communities. And so I think this whole process of re-reviewing is a good thing.
So last question. I have a little thesis.
Yeah.
Tell me what you think. For years, the Fed really was against M&A in the banking world. I mean, just totally against it. And it made any M&A extremely difficult. And I think one of the things that's happened is, number one, obviously the cost of regulation is much higher.
Yeah.
But more importantly, number two, the role of tech has so exploded.
That's right.
That the large banks like JP Morgan have an enormous competitive advantage because they can afford all this tech and the other guys can't.
And they have an enormous advantage in gathering deposits over small banks.
Well, they keep taking share in deposits.
As you'd understand, given you only have insurance up to $250,000, the big banks have an enormous advantage.
So I'm of the thesis that there needs to be an M&A wave in the United States and banks because if there's any hope of any banks competing with JP Morgan, they got to get bigger.
So let me put it.
Where is the Fed on this?
Well, I'll let the Fed speak for where they are. Let me tell you where I think they ought to be. Mm-hmm. There are something like 4,150 banks in the United States.
Correct.
Okay. So only 80 of them with assets over $20 billion. That's not that many.
No.
Okay. I think there will likely be substantial consolidation among that 4,150. I also think there's room. You'll see consolidation below the level of the very largest banks. And I think that's a healthy thing, and it will create more competition, and it will allow these banks to more ably serve clients. And one of the things to keep in mind, we're running a historically high deficit. Debt to GDP was in the mid-70s pre-COVID. It's now over 100%. We need more GDP growth. The banks have got to be one of the vehicles. They have to be more aggressive in deploying capital to serve clients. And I think to the extent if there's more consolidation, more regulatory review, maybe it frees up more capital so they can create more organic growth in the economy rather than government-led spending growth. I think that's a good thing for the economy. And I think more sensible cost-benefit balanced regulation will be a key thing to help improve GDP growth so we can help deleverage. So I think it's a good thing.
Rob Kaplan, thank you.
Thank you, Steve. Good to talk to you.
Good to talk to you. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.